everyone, and welcome to your Daily 5. I'm Joe Duarte from JoeDuarteandTheMoneyOptions.com, author of Options Trading for Dummies in the 4th edition. If you like what you see today, consider a free trial to my website, JoeDuarteandTheMoneyOptions.com. All right, well, let's get going here. We're at the edge of chaos as always, and today we're going to talk about when and how to fight the Fed and win. So our goal is to sort out the market's truth, and we're going to be using the news as a guide and then gauge the market's response. And then we're going to home in on what's really happening via price charts. So quick look at Duarte's sound trading principles. Don't fight the Fed. This one's got an asterisk in this video. We're going to remain patient, wait for opportunities. And the key here is to watch the news, but trade what you see in the charts. So how the news cycle work is our first topic here. And the news is how the news cycle works is what we're going to be looking at here at the beginning. And the news is what sets everything up. Okay, the news cycle is what sets what the market's going to do. And so what happens is that the market reacts with volatility when news is released. And of course, before that, you have a prelude, which is that the market setups are based on the news flow that happens before any event. And what happens is that when the market gets surprised, there's volatility in prices. So in order to keep that from happening, we want to keep up with the news trends and see what the market is expecting. But we want to plan our trades based on potential outcomes, knowing that the news can be wrong and the markets are fickle. For example, the Federal Reserve's announcement on interest rate that happens every 4 to 6 weeks. You have the prelude, which is that there are articles in the press, there are speeches by Fed governors and the president, and chairman, there's interpretation, there's opinion, and this creates the market setup. Then, of course, you have the announcement, and then you have the initial market response to the announcement. Oh, the Fed raised interest rates, let's drop stocks. Oh, the Fed lowered interest rate, let's buy stocks. Then you have the press conference in which Chairman Powell usually makes things crazier than they were after the initial announcement. But the really important thing is what happens the next 24 to 48 hours after all this confusion. So what we want to do is focus on this particular set of words that I like to use to get myself focused. And that is, if this happens, do this. So in order to do this, if this happens, do this exercise, we want to study event history. We want to analyze the current market setup. And we want to develop those strategies that are can be beneficial for us in positive or negative responses to the news. So when do we fight the Fed? I'm about to tell you. First thing we want to do is check out history. And history says don't fight the Fed, and history is absolutely right. This upper chart here is the Fed funds rate in 2022. You see it keeps on rising. This chart down here is the S&P 500, and you see that the S&P 500 drops when the Fed raises interest rates. Everyone knows that. I'm going to show you some exceptions to this in a bit, but it's important to understand the history. You can also see that every time you have these circles here, it's when the Fed actually does the deed, and that the market usually turns negative after that. So history says don't fight the Fed. I agree 100%, but there are exceptions. I'm going to be telling you about those. Next, we want to look at the current market setup. Of course, people that have seen my videos before know that I look at the market based on the advanced decline line, New York Stock Exchange advanced decline line, which is this chart. Also look at volatility based on the CBOE volatility index. You can see that when it goes up, it means that there's increased volatility because the market is full of put option buyers, and the market makers have to sell stock index futures to counter that in order to hedge their account. We also want to keep a look an eye on liquidity. And of course, the Euro-dollar index tells us that how liquid the market is. And here in the short term, liquidity has improved, and you can see that that improvement had led to a market rally. But now you can see that starting to roll over. You can see that as the Fed recently raised interest rates, the market has now fallen. And you can see that every time in this particular market, over the long term, the 200-day moving average for the New York Stock Exchange advanced decline line is essentially a resistance level. So you've got your history here. You know that increased volatility leads to falling stocks, and you know that when there's no liquidity, the market just doesn't do very well. So who wins when the Fed raises interest rates? Well, often it's the bond market under certain conditions. And of course, there are individual sectors of the stock market that win as well. So the traditional winners when bond markets rally and yields fall are home builders and real estate investment trusts. So we're going to focus on that here in the last few slides. So we want to make sure that we look at the entire picture and how everything works together. So let's first look at the Fed funds rate. You can see it's been rising. And if this chart was extended a little bit, it would show that it had they would have risen further. You can see that for most of this cycle, the bond yields on the U.S. 10-year notes have also risen. You can see that home builders such as Lennar, which is a stock I own and I recommend it on my website, around here, by the way, had been falling as long as interest rates keep going up. But somewhere along the way, there was a divergence or a decoupling. When bond yields fell, Lennar rallied. And again, when bond yields started going up again, Lennar fell. But guess what? Bond yields are falling, so Lennar has been rallying. So this gives you a great opportunity to fight the Fed. You look at the Fed funds rate, but you also look at what bond yields are doing, and you can actually make some profitable trades in home builder stocks based on this divergence I've looked at here. The second place is the real estate investment trusts. And I chose WP Carey, which is a stock I own and also recommended on my website. In fact, I recommended it right around here. And this is an interesting REIT because it charges its customers based on inflation. In other words, it raises its prices along with inflation. Therefore, when Fed funds rate was rising and bond yields were rising, WP Carey tended to be moving higher. But look here, at 4% on the Fed funds rate and above 4% on the 10-year note, the stock collapsed, just couldn't take anymore. However, when bond yields rolled over, guess what? WP Carey started rallying again. So the message here is that select REITs love lower bond yields under certain conditions. So let's recap. We never want to fight the Fed unless certain things happen. When those things happen, in order to fight the Fed, you have to know your history. You have to watch the news to gauge the market setup. You have to be prepared. If this happens, do this. You want to pick those trading vehicles. You want to review them like clockwork, make sure that everything is working as it should and that your timing is correct. And the bottom line is you fight the Fed when bond yields and Fed funds decouple and your sectors respond favorably. Well, that's all I have for today. I'm Joe Duarte from Joe Duarte and the MoneyOptions.com, author of the best-selling options trading for dummies, now in its 4th edition. And if you like what you see, please consider a free trial to Joe Duarte and the MoneyOptions.com. Remember, trading is uncertain. Always be prepared.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.